Rao, Managing Director and CEO with SBI Card joins us. Now, Mr. Rao, good morning. Thank you for joining us. Let's understand things for the quarter gone by for SBI Card. NIMs have seen a steep sequential downtick. What is causing this pressure, and when do you think NIMs will stabilize?
Given the balance sheet structure, where the loans carry fixed rate of interest, while they are funded by short-term borrowings, whenever there is an increase in the interest rates, the cost of funds increases much faster than the yield on the loans, putting a pressure on the NIM. So we guided in the past that in Q3 we are likely to see compression to the extent of 50-60 basis points. But we have seen, in our portfolio, when we look at the kind of repricing that happened, we are very confident that in the next quarter, the impact will be limited to 30 to 40 basis points in terms of further increase in the cost of funds, which can be mitigated through two actions. One is by constantly increasing the share of EMI loans, which can actually improve the overall interest income. Second thing is transmitting the increase in the cost of funds increasingly in terms of new loan dispersals. So broadly, we are expecting a kind of stabilization of the NIM. I'm saying in the broad terms in the next quarter.
Your receivables are up 2% when cards in force are growing at a healthier clip. How should one look at receivables going forward?
It has to be looked at from two aspects. First thing is whenever we card a new customer, it takes time for the customer to get used to using the card. They will only, we have seen over a period of time, 2 to 3 months they take in terms of actually using the card in a big way. So the utilization of the limit happens over a period of time. So that way, the acquisition will not result in a corresponding increase or immediate increase in the NEA. Second thing is during the month of September, particularly during the last week, we have clocked in more than 2,500 crores of festive spends. So this has gone into NEA. So when we compare the Q3 NEA with the Q2 NEA, we are comparing with a higher base. So that's the reason why the sequential growth appears to be muted. But overall, when we look at on a year-on-year basis, we are confident of maintaining a growth of around 23 to 25% kind of NEA growth year-on-year over a period of time.
Right. But, even though your market share of cards in force is rising, your market share of spends and transactions is falling. So if I understand right, is this a lag of a quarter? No concern really in the long term for you?
We are mindful. We are mindful of the difference between the market share in cards versus the market share in the spends. Particularly in the past also we alluded to the market share in the spends to some extent is colored by the play of the corporate card spends. Depending upon which player is clocking more corporate card spends, the market share volatility will be there. So our stated objective has always been to reduce this gap between the share of the cards in force and the spends through increased engagement efforts, by working with the existing customers, making the right offers, and of course playing in the game of corporate card spends also in a calibrated way. We want to steadily improve the market share of the spends, but of course in a very calibrated manner and in a sustainable manner.
Your credit costs have risen in the first or rather second quarter. You had suggested it was momentary. How would you view the credit costs this quarter, and how do you see them going forward?
For the record, credit costs in Q3 have come down as compared to Q2. So Q3 credit cost is at 5.6% as compared to 6.2% in Q2. So there is an improvement there of almost 60 basis points, particularly when we look at the ECL, which is a better indicator of the portfolio quality, that is at 3.3%. So it's a slight improvement by around 3 basis points as compared to previous quarter. It indicates the portfolio quality, particularly the stage 1 share. When we look at in the NEA, it has crossed 91%, which is our BTD based. So we are confident that the credit costs, if we ignore the quarter-to-quarter variances, it will be largely range bound, and we are confident of keeping the credit costs below 6%.
Good morning, Mr. Amara. How should one look at SBI Card's NPA ratios? Because the fact is it's gone up in the second quarter as well. Why should it be that your shareholders and the analyst community at large should not see this as a red flag?
I think in sequential terms, perhaps when we look at, there is a few basis point increase in the GNPA, but this is much lower than the pre-COVID level. And these NPA also, we have ways and means of resolving these NPAs and recovering the money. So here also, it will be a kind of range bound, perhaps maximum 2.4 to 2.45% kind of GNPA one can expect, given the profile of the customers what we deal in. So current level is not a concern because ultimately we look at the overall credit cost, which is well under control as of now.
Now, Mr. Amara, for the period and the quarter that's under review, if you look at the OPEX, that's gone up 8%. I'm doing a quarter-on-quarter comparison. The cost to income has also, and if I'm looking at it, remains elevated. What can we expect from SBI Cards in the quarters to come when it comes to CapEx as well as investments? Is this going to go up?
Yes, during the quarter Q3, revenues increased by 16% and OPEX increased by 15%. OPEX increasing to this degree in Q3 is not completely uncharacteristic because Q3 is marked by a lot of festivals, so we make a lot of cashback offers. Traditionally, Q3 has always been elevated in terms of cost to income. But if you look at of course, the other factor is around the increased customer acquisition. Q3, we clocked in around 1.6 million new customers, which is almost like a 60% growth as compared to 1 year back. So this is more like an investment for future, building a scale for future, where the benefits will accrue over a period of time in the next few quarters. So this has actually created a kind of increase in the cost to income. But as I said about the seasonality, Q4 generally is much better as compared to Q3 in terms of cost to income. So we are very confident that the cost to income overall will be lower than 60% in Q4.
Understanding your rollover mix, last time when we spoke, it was stagnant and continues to be under pressure. How would you assess and how are you resolving this?
I mean, the current level of revolver is 24%, which is the same level as Q2, which when we compare with pre-COVID levels, it's around 60 to 65%. This is in line with the industry trend. We are taking a number of measures in terms of attracting more of a younger customers, self-employed customers who have a better propensity to revolve. But at the same time, in line with the changing preferences of the customer, where the preference is more for availing EMI loans, we have also steadily increased the share of EMI loans. So each quarter we are seeing a kind of increase of 2% in the share of EMI loans. This is helping us to optimize the revenue while creating a right environment for the build-up of the revolver. So the pace at which it will increase, it's not at the desired pace, I will say, but we are confident over a period of time it will come back.
Right. Thank you so much for taking the time out and joining in today to highlight what your quarter has been and, of course, what the future visibility